Okay, today I'm looking at a deep value stock, and I want to address what is the key difference between gambling and investing. So, ironically enough, I'm looking to invest in gambling.com. But what I have come to believe is the core distinction between gambling and investing, because yes, both of these activities have an element of risk, they have an element of uncertainty. But with investing, you can create for yourself a margin of safety that you cannot create with gambling. So one of the key inspirations for this line of thinking I got from this book by Benjamin Graham, The Intelligent Investor. Would highly recommend. It is a thick book and it's a long read, but I would highly recommend reading it. This is the guy who inspired Warren Buffett's style of investing, Charlie Munger, of course, as well. Let's see who else. There's several big names. Drawing a blank. Bill Ackman is also a big supporter of Benjamin Graham. And the key concept that is outlined in this book again and again is finding a margin of safety. So what I mean by that is we can look at a huge growth stock like Palantir. And Palantir, in fact, let's pull it up really quick. Let's just pull it up. Palantir has a strong growth trajectory. And if they hit the growth trajectory, PLTR, that they are supposedly going to hit, then they might justify their current share price. Their current share price is hinging on massive growth. If any little thing goes wrong in the next 5 years that slows down their growth from, say, let's see, what is the analysts say that their average expected growth is what? I believe it says it. Well, let's go to the forecast. So the analysts believe on average that we're looking at 48%, 37%, 32%, 44%, 33% over the next 5 years. That is a huge amount of growth. And if they are wrong, and let's say Palantir averages 25% growth over the next 5 years, the difference is staggering. So I should have had this pulled up already, but let's just pull up a compound. No, sorry, I'm typing in the wrong thing. Investment return calculator. So if we look at $10,000 over 5 years with let's see, we're looking at like roughly a 35% average growth rate. Oh, after 5 years, oh geez, then we end up with $44.8 thousand. If that growth rate, if the analysts are wrong by just a little bit and they have a 25% annual growth rate, then we're looking at $30,000. That is a difference of 33% in revenue. That is a huge difference. I mean, we're talking about like if we scale this up to billions instead of 30,000, this is a $14 billion difference if the analysts are wrong by a small margin. So in this case with Palantir, this is just an extreme example. There is very little margin of safety. And if we look at the overview on this company, we can see that the PE ratio, the price to earnings ratio is 435. The forward PE ratio is 200. This company requires tons of growth. So that's what I mean when I'm saying a margin of safety. I want to find a company where if they undershoot their projected earnings and what they've accomplished in the past, if we look at what's on paper, the permanent record of how this company has performed, if they're able to perform as they have been, or if they're able to perform as expected, or if they underperform both of those, I still want the stock price to have returns in it for me. This is the margin of safety that I'm talking about. And I believe there is a massive margin of safety in gambling.com. So how do I go about calculating this margin of safety? I'm not simply looking at the PE ratio or the forward PE ratio. I am using the projected free cash flow going into the future. I use the discounted free cash flow model because the free cash flow is the chunk of money that is my return as an investor. Free cash flow is what gets spent on paying a dividend, buying back shares, acquisitions and mergers, growing the company organically through capital expenditures, or paying back loans. These are things that are paid for by free cash flow, and these represent my return on the investment. So that is what I am most concerned with. So with gambling.com, let's quickly go to their forecast. The analysts, by the way, believe that this company is undervalued. Strong buy from 6, a buy from 1, and a buy and a hold from 1. But if we look at the revenue projections over the next 5 years, we see 38%, 11%, 11%. This is the average. This is huge. This is a huge revenue projection, revenue growth. So I want to make sure that I have a very strong margin of safety. So here I have built a discounted free cash flow spreadsheet where I can very quickly calculate the discounted future free cash flow of companies based on several assumptions. So first I want to go with the analyst expectations. Let's say that after the analyst period, let's see, sorry, I'm struggling a little bit. Okay, 5%. So here I have pasted in the analyst expectations for future growth over the next 3 years. I have then entered in my own expectations for years 4 and 5. I just basically followed the trend of what the analysts were projecting for the next 3, but I lowered them slightly. So 15 and 10 for the high revenue growth projections, 10 and 5 for the average, and 3 and 3 for the low. I have also assumed that in years 6 through 10, they are going to grow their revenue by 5%. I am assuming a perpetual growth rate of 3%. This is roughly somewhere between inflation and the GDP growth of the country. The perpetual growth rate cannot exceed the GDP growth of the country because over time it would dwarf the total economy. So it has to be less than the GDP growth. It should be slightly more or equal to inflation. I'm going with 3% in this case. So based on these assumptions and that they continue with their past average free cash flow margin. So the way I calculate their free cash flow going forward is I take revenue projections and then I use their historic free cash flow margin. That's the percentage of revenue that they turn into free cash flow. This is my starting point. How did they do on average in the past? Let's project that into the future. They averaged about 28%. And based on these assumptions, the analyst high, analyst average, and analyst low, I'm seeing a fair share price of anywhere between $25 per share and $43 per share. And if we just remind ourselves what the current share price is, it's $7 per share. So this is a little bit of a red flag because like something must be wrong, right? This is simply too good to be true. It cannot have this high of a projected share price. It's insane, right? So this is where I start to build in a factor of safety, and it requires a little bit more research into the stock. Whenever I see numbers this high, usually that means that there is something being accounted for in the stock price that the analysts are thinking about, that the market is thinking about, that is pushing the share price lower than, say, $33 per share as the average analyst projection. So the first thing that I look at is the free cash flow margin. You know, the revenue is what it is. Analysts believe this is going to be the margin. What I have not looked at what the analysts believe about the free cash flow margin or the profitability in general. So if I go back to stockanalysis.com, we can see some forecasts on earnings per share. Okay. Revenue forecast, revenue growth, earnings per share forecast. So many analysts believe that in the next year, the earnings per share or the profitability will go down and then it will recover going forward. So there is some profitability loss going on here. So first thing let's do is let's adjust this profitability. I'm going to reduce my free cash flow margin of 28. So one thing I look at just right off the bat to adjust it a bit lower is I take money away from free cash flow for stock compensation. If they are paying their employees with stock and then they're turning around and they are buying shares back through a stock repurchase program, then stock-based compensation needs to be counted against free cash flow. Whereas the default is that stock-based compensation is added back into the cash flow because it's not actually a cash expense. Buying back shares is a line item further down. This is in the financing category. So in the operations category of free cash flow, which let's go ahead and pull that up. Let's just do a quick look at the financials. So we've got the cash flow. This is divided up into three major categories. Operating cash flow, this is how much money came, the amount of cash that flowed in and out of the company due to its operations. Then the next category we have is investing cash flow, where they are spend. Usually this category is negative, as a company is spending money on investments. Cash is going out of the company in order to buy, in this case, cash acquisitions is the big expense here. They bought a company, they merged with a company. And then the final category here is financing cash flow, whether they are receiving cash through loans or they are losing cash through paying back those loans or issuing stock / repurchasing stock. So here we can see that they are spending money repurchasing stock. I do like that. However, they are also giving out $6 million over the last 12 months in terms of stock-based compensation. So this $6 million, I count it against the free cash flow. I also count acquisitions slightly against as well, even though it's not normally counted against, because generally you're buying companies at a slight premium. So I do count, in this case, I'm counting 10% against for cash acquisitions. So the result is we have a new average over the last 5 years of about 23-24. So I can lower the free cash flow by 3%, -3, and we are still seeing massive upsides here. So what kind of margin of safety am I going to be comfortable with? So first, I want to assume that let's just completely take away the insane revenue increases over the next 5 years. And actually, I'm going to take them away going into infinity. So instead of averaging 15% over the next 5 years, this is for the my projection category, I'm going to set it to 2%, which is very conservatively inflation. Maybe even on the lower end of inflation. Perpetual growth rate, I'm going to set to 2%. Next years 6 through 10, I'm going to set to 2%. And we have our discount rate here, which I just realized I forgot to explain. This is the annual return that I want every year. So I'm expecting an 8.14% return every year. And then this upside that I'm seeing is in addition to the 8% return on my investment every year. I am buying this company at a huge discount currently. So just to be completely clear, if they have a free cash flow margin going forward of about 25%, let's actually make it 24%. 24% free cash flow margin. If they only are able to grow their revenues by 2% from now until forever, just with inflation, and I'm able to receive, and I'm expecting an 8% return, then right here, this is my projection. This is taking into account all these factors. I have an upside of 71% on top of this 8% return, because that would put the fair share price at 12. The current share price is 7. So this is what I'm talking about when I say a massive margin of safety. So even with just very slow revenue growth and a slightly lower free cash flow margin, we're seeing a huge potential upside. But I still need to go a step further, because you have to make sure that there's not some gap in your understanding, because something is still going on here, surely. This is just too big of an upside. There has to be something else here. It's probably not revenue, because I've already severely undercut the analysts in terms of revenue growth. So there must be something else here. And also, I would like to point out that analysts are generally pretty close on revenue projections for the upcoming quarters. So we're already halfway through. If I go to the quarterly statement here, we've already had quarters 1 and 2. So as far as projecting the revenue for 2025, we're already halfway through 2025. So the analysts are going to be pretty dang close in terms of the 2025 annual revenue. I mean, they're not going to be very far off. So what was their projection again? For 2025, they're saying a 38% revenue growth. So by me saying 2%, I mean, that's just, it's incredibly unlikely that the analysts are going to be so far off on just next year's revenue growth. And by the way, it would take probably 10 years, 12 years. No, sorry. That's bad math. Maybe 15, 16 years to at 2% revenue growth for them to get up to 176 million. So like they're going to hit 176 million this year, and I'm assuming they're not going to hit it for a long time. So I just want to continue to put that into perspective, how how much of a margin of safety I'm building into this. So let's look at profitability again. So when I pull up their most recent quarterly report, the big thing that they did here is they entered into a definitive agreement to acquire Las Vegas-focused booking platform Spotlight.Vegas. They also expanded their share buyback program by 10 million. So now they are able to buy $20 million in share buyback, which if they are indeed trading at a deep value, a deep discount, then I like this. I like that they are expanding their share buyback. I see that as a very good thing. But okay, so let's look a little bit more into this acquisition. So if I do a control find here for Spotlight, okay, where do they talk about this? Okay, enters into a definitive agreement to acquire Spotlight.Vegas. So this company will pay $8 million upfront at closing for the acquisition, and they will pay an additional $22 million subject to certain performance targets being met through the end of 2027. So they may have an additional expense of $22 million, an additional $22 million through 2027. So this is cash leaving the firm over the next 2 years if their acquisition does well, which we hope it does well. So I'm going to assume that let's assume that this money is going out the door. So they're going to lose 22 million. Now, how much money do they think they're going to make off of this acquisition? Let's look at that. So this is their most recent transcript from their most recent earnings report where they went through the Q&A section. Right here, Ryan Sidgal says, on Spotlight Vegas, can you give however you want to quantify it? Anything from the past few years from a financial statement. Oh, wait, sorry. Is that the one I wanted to read? Okay, yeah, this is the one I wanted to read. Okay, sorry. Let me back up. He's asking, was Spotlight Vegas growing? Was it profitable? And then put 2026 estimates into perspective. Give us a little bit more context around this company. So he's asking, was Spotlight Vegas growing before we bought it? Was it profitable? So that way we can know what we can expect as shareholders for, like, are we going to increase our revenue and our profits from this? Or is it just going to be a revenue boost, but we're going to end up with losses? You know, if this company is losing money and we buy it, then we'll be losing money. So what does he say? If you look at 2024, it was growing nicely. Okay. It did over 30 million in platform turnover and it was profitable. So it was growing and it was profitable. Those are his words. It is a lower margin business at this scale, but as it scales, it grows its net margin revenues. At the moment, our expectation is that it will roughly break even. So what I'm hearing is a lot of this revenue growth in 2025 is going to come with zero free cash flow growth. We expect, together with a little bit of a rebound in seasonal strength and a little bit more efficient marketing, when we get our hands on it, we're guiding towards 8 million in net revenues and 1.4 million of adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization for 2026. So in 2025, they're saying it's going to break even in terms of EBITDA. In 2026, they're saying they're going to be making a slight profit. This looks to be about 12 to 15% margin, EBITDA margin. So this is what they're saying. So in 2025, what I'm going to now build into my spreadsheet, my margin of safety, is zero free cash flow growth going from 2024 to 2025. I'm going to assume free cash flow growth doesn't increase at all, which means I'm going to assume that margins are going to plummet in 2025, but then I'm going to keep my 2% growth going forward. So things are going to grow by 2%. I'm also going to assume that margins don't get any better. I'm just going to assume margin drop, no margin improvement, even though they say they think they will have margin improvement. This is the level of factor of safety that I'm building into this assumption. So if I now put in negative 10% past free cash flow margin, negative 10%. So now we are at 18% free cash flow margin. That's our assumption going forward, even though the average over the last 5 years was 23, 24%. Okay. Also, I want to go into the back end calculations here just a bit, just to show you what I'm looking at here. So free cash flow in 2024 was $36 million. Their revenue was $127 million. Their free cash flow margin was $36 million. So in my new calculation, this is where my calculation is going. I actually have free cash flow projected for 2025 at $23 million. So actually, and then in the next year it's $24 million and change, $24 million in 2028, it's $25 million. In 2029, it's $25 million. So I have lopped off like a huge chunk of their free cash flow. We're going back in time basically to, kind of between 24, 2023. So I just want to put in perspective how much free cash flow I'm lopping off. I am destroying their profitability. And even with that assumption in place, my projection shows a 20% upside on top of the 8.14% discount rate. So when you ask me, is this company undervalued? If you take these assumptions to be conservative, as in they're likely to exceed these assumptions. If you think that gambling.com is likely to exceed 2% revenue growth going forward forever, and they are going to improve their free cash flow margin above 14%, right? I'm assuming 14% free cash flow margin, and you are happy with a return of 8.14% per year, then it's 20% undervalued. I mean, that's the math of it. If you take these assumptions to be reasonable, they are certainly undervalued right now based on these assumptions. And just one more time, just to drive this profitability point home, 14% free cash flow margin. Let's go to the financials and just on their free cash flow, on the income statement, I can see their margins. And let's look at quarterly margins so we can have a little bit more granularity. Or no, we'll start with annual. If I go down to the margin tab, free cash flow margin, 31%, 28%, 16%, 24%, 32%, 38%, 19%, 24%, 27%. This is annually. This is going all the way back to 2017. So I'm assuming 14%. That's way low. And on the quarterly if we look at it quarterly, it's going to be a lot more up and down by quarter because they've had other acquisitions in the past that are performance-based where they buy the company initially for a small price, and then if it performs well, they pay significantly more. We can look a little bit more into that. Okay, Hokage says, looking at the chart of it's gambling.com, it seems to oscillate between $6.5 and $17. Good find at a good timing. Maybe the last time it comes to this low level. Maybe. I mean, it certainly looks really good. Hokage also asked, how is their share buyback plan? So if we go to their most recent quarterly report, they expanded. This is back in August. They expanded their share buyback program from 10 million to 20 million. And if we look at how much money they've spent on their share buyback program previously, I believe it's an increase. Let's look and see what it is. Not stock-based compensation. Repurchase of common stock. So this is quarterly. Annually. Okay. Repurchase. So 17 million over the last 12 months, 27 million in 2024. So they're not quite to their 2024 levels, but 20 million, it's not bad. If we look at their share count, let's look at their share count. If I go back to the income statement, if we see how many shares as a percentage they're buying back. So in 2024, they bought back 5.7% of their shares. Now, as far as I'm concerned, that is equivalent to a 5.72% dividend, except we didn't have to pay taxes on that dividend, and they're buying back shares at a good level. Over the past 12 months, they have reduced the shares outstanding by 5.86%. So, honestly, in this upcoming quarterly report, do I expect them to expand the share buybacks? This is complete conjecture. Let the record show. I don't know, but I would guess that they won't, because what we saw here, the amount of money that they're going to have to spend on Spotlight Vegas, an additional 22 million subject to certain performance metrics. So if Spotlight Vegas is doing well, then they're going to have to be dropping more money into this acquisition. And the goal, the reason they do this is, number one, it allows them to fund this purchase through their operations, their cash from operations, instead of having to buy the full 30 million up front and then get a loan. They're able to put 8 million this year, maybe 11 million in 2026, and then another 11 million in 2027. It spreads it out a bit. It allows them to take on less debt. And if it doesn't perform well, then we don't, as shareholders, we don't have to pay as much. So how long before this really pays off? I mean, if they're putting 30 million into this and they're expecting 1.4 million after 1.5 years, it's not the best margin right now, but they're saying that their margin will improve. Why are they doing this? Why are they diversifying so much? Let's look at that. Okay. Our second quarter performance was driven by two factors which reflect important broader trends in business. First is an accelerating diversification away from traditional search channel in favor of a more omni-channel approach, in particular with the marketing business. So their core source of revenue is marketing, and they are reliant on Google search. And they have been performing very well with their search engine optimization. However, Google every now and then will update their algorithm and change it. And then this causes a little bit of disruption with this company. And they've just gone through this. They're going through the process of retaking their position in the search engine optimization. AI is changing that calculus a bit. So they want to diversify away from just the marketing. So they are getting end users to other companies that are going to monetize those users, and then those companies pay Gambling.com for that marketing service. Gambling.com is starting to vertically diversify across this whole gambling niche, I guess we can call it. So they've also acquired another two businesses, which we can look at in a little bit, that really take account for the end user. So they've got more sports stuff going on, sports betting. Let's look at this. Second is an accelerating diversification into revenue models beyond marketing, including sports data services. Our marketing business continues to deliver market share and tremendous cash flow. That performance was driven by more and growing contributions from channels other than search than ever before. So they are diversifying away from just pure search. The growth in our exciting sports data services businesses accelerated in this quarter despite negative seasonality and was responsible for over 25% of the revenue. So that's nice. That's all high margin. So that's good. So it's really just this new business right here, this Spotlight Vegas, that is going to be bringing down their profitability going forward. Okay. Okage, if you compare stock-based compensation, it looks like only 30% of the share buybacks is stock-based compensation. Yes, that is true. That is true. So that's a good point. The stock-based compensation isn't sucking away all of it, but I still will count that chunk of stock-based compensation against free cash flow. So it's basically negating a portion of their buyback, their stock buybacks. So, but yeah, 30% isn't the worst. We've seen worse, certainly. I would like to see it lower. One big red flag that we'll look for as we keep track of this company is, do they start ballooning this number right here, the stock-based compensation? So in 2022, it was 3 million. And over the trailing 12 months, it's 6 million. So it does seem to be increasing, as long as this doesn't start to just, exponentially shoot up, and their net income was 14 million. So, 6 million of that is coming from, you know what I mean? Like, as a percentage of their net income, it's pretty big. So I don't like to see it, but I'm not, like I said, I'm not focusing on net income because I'm more focused on the free cash flow. You know, net income is reduced by certain things like depreciation and amortization, for instance. So in any case, this company appears to be deeply, deeply, deeply undervalued. So this is the company, Gambling.com, that I will be investing in this week on my public YouTube portfolio series. Let's look at the portfolio really quick. Okay, so let's first check out my performance compared to the benchmarks. I have been looking at the year to date. So this year, we've had more volatility than the benchmarks, and we are edging out the S&P 500 still. So our YouTube portfolio is up 21.5% year to date. The S&P 500 is up 16.5%. We are outperforming Vanguard Total World. We are outperforming iShares Growth Index. So the portfolio is still looking good. I will say to take this with a grain of salt because this is just year to date. This portfolio is not very old. So it is more focused on long-term gains. So I am calculating whether or not I think these companies are undervalued. The market may not agree with me for a while. It may never agree with me. It may turn out that some companies I invest in are in fact not undervalued and they were low in price for a good reason, you know? So I guess my point in saying this is I'm trying to focus on long-term gains, and it's just a nice bonus that we are currently up in the short term, but this isn't necessarily going to stay intact. I don't know that it will go down or it could go up further depending on how quickly these investments pay off. But we are continuing to invest in companies where there is a significant margin of safety. That is the key. That is the key premise of my investing philosophy, is make sure that there is a margin of safety. So that is the plan. Oh, let's go ahead and look at the holdings. Okay. And we will filter by gains and losses. And let me expand this a bit so we can see all of this in one screen. Okay, I'm just going to cover my face up for a bit. So HIMS is still on top. ASML, Google's still doing well. Recently, we invested in Meta after it had its earnings report. It had a big one-time charge on tax. I can't remember all the details, but a big tax hit that it wasn't expecting. So it is currently down 4%. I am very tempted to put a little bit more into Meta. In fact, it was down. It was like at 630 at one point, and I did not make a move. I kind of drug my feet. It's coming back up since its recent low, but Meta is looking very nice lately. Let's scroll down to the very bottom here. Crocs, I continue to have high conviction, and this is an example of what I'm talking about. I believe that Crocs is undervalued with a significant margin of safety. However, I've invested in this company quite a bit. It is down 15% still. So this is looking like it's a major hit. On the other hand, a company like HIMS, I saw significant potential upside with this company. It wasn't insanely undervalued when It's certainly not insanely undervalued now. It's because it's gone up so much. So this is just an example where, like, the more speculative stock, it had a slight margin of safety with a very good upside. It's up quite a bit, 70%. But the company that I have more conviction in with a higher margin of safety is down 15%. So it's hard to say how long until the market agrees with me, if they ever do. And there could be more information that comes out that makes me change my mind about Crocs, and then I just have to bite the bullet and lose $63. That could also happen as well. And same thing here with Simply Good Foods. This was another slightly speculative pick, but it currently has a massive margin of safety, and so I have doubled and tripled down on this company. So in any case, okay, Hokage says it would be nice to see what the average cost basis you bought each of these. So average cost basis, where would it show? So it tells me my average price. Here, it does say it. Okay. So HIM's average price was, 25. That's right, isn't it? Let me just double check. Yeah, it's up at 43. My average price was 25. So along this column, you can see my average prices. So if you want to keep track of these. I'll review the portfolio every time, but yeah, if you're curious to write any of these down, just keep track of them on your own, feel free. Let's see here. Yeah, going back down. So Adobe, I feel like it has a really strong margin of safety, but it is currently down. PayPal, really good margin of safety. It is down. So, there's going to be instances, plenty of instances where I have strong conviction in a company, but the market just doesn't believe it yet. CoreWeave, a more speculative pick of mine. It is currently down. It was up before. Anyway, this is the portfolio. These are the losers. These are the ones that I need to continue to keep an eye on and make sure that more information does not come out that changes my mind on these companies. That is the key. As more information comes out, I have to update the model and see if it still has the same margin of safety that I enjoyed previously. Okay. For anybody in the comments, if there is if I can move this back. Okay. Okaje, if there's any companies you want to check out, let me know. I'm happy to look at some companies that are suggested in the comments. I think that would be cool. In the meantime, while I'm waiting for anybody in the comments to hit me with a company that they would like to look at, I'm going to pull up Simply Good Foods just because it is at the bottom of the spreadsheet. So let's look at that. Forecast. The analysts like it. Oh, and I just realized something that I forgot to pull up before. Charles Schwab equity rating for gambling.com. Charles Schwab gives it a D. They think we should sell this stock. Critical process, DUOL just plummeted. Hokage says, as always, very good find. We might have good opportunities to double down on good stocks due to a bear market. You're 100% right. I'm definitely going to be keeping that in mind. So critical process wants me to look at DUOL. Oops. Dang it. Okay. What is this company? DUOL. Oh, Duolingo. Has been going down quite a bit, hasn't it? Okay, we can check out Duolingo real quick. This is not going to be a super deep dive, but a quick look at the discounted free cash flow based on analyst opinion here. Let's see. Okay, so revenue forecast. The revenue forecast looks really strong for Duolingo. So the analysts believe... Oh, check the after hours. Okay. I will check that. Give me one moment. Does that mean that they had an earnings report come out today and it was bad? Is that what that means? Bear with me here. So Duolingo after hours is down 20%. Jeez. That's a ouch. So it says they beat their earnings by like a ton. What happened there? I don't know if this is most recent. Let me pull up their most recent earnings report. DUOL Investor Relations. What happened to this company? Press release. November 5th. Duolingo surpasses 50 million daily active users. So, oh yeah, they did indeed announce their quarterly report. What happened? Why did it go down so much? We've had a great 2025 so far. Revenue up 40%. I mean, I'm not seeing it, at least in the verbiage here. What are people saying about it? Uninspiring guidance. Duolingo reported Q3 earnings after close on Wednesday. So they beat They did not have as many active users as they thought they would have. It was down by like 2%. Full year sales guidance of between 1.028 and 1.032 versus the expectations for 1.018. I mean, the company's net income benefited from a one-time tax-related gain of $223 million. That's why it pushed its earnings up so high. That was far in excess of expectations, but that's not what we care about because that was like a one-time event. So it looks like there was a public backlash because they are an AI first company now, according to Critical Process. It was earlier this year, though. So that's another reason for drops in the past. Active users triggers sell off typically happen to Meta and Netflix. So this could be a really strong opportunity. This is what we're looking for. This is, a lot of times, now I'm not saying this is necessarily the case for Duolingo, but a lot of times when you have a company that has really strong growth projections and the market prices it accordingly. The market prices the stock very high because it thinks it's going to hit these ideal revenue growth, profit growth metrics. And then if it slightly underperforms those metrics, then the price rightfully goes down. But a lot of times that momentum causes the price to keep dropping and keep dropping. And investors decide to sell out because they say to themselves, wow, this stock dropped 40%. It's too risky, right? But a stock dropping does not make it risky. The stock's price makes it risky. So when they bought it, it was risky, and then it's dropped, and now it may actually be less risky. So that's what we're going to look at. Yeah, let's look at that. That looks interesting. Let's forget about Simply Good Foods for a minute, and let's look at this one. Okay, let's copy those revenue projections. Now, these may be outdated because these are the analyst consensus earnings expectations that, are probably old. They just had an earnings report come out. So these are outdated, but I'm going to go with these anyway. I want to let the record show these revenue numbers, take it with a grain of salt. Okay. And they only gave me 4 years, so I'm going to take some liberties here. And you know what? We'll just leave it like it is. 25 down to 10, 17 down to 5, 9 down to 3. We'll just make it a little bit more conservative. And we want to go DUOL 0. We'll go 5, 3, 5. Okay. Also, what is the current share price again? So the current share price is 209. It looks like it may be overvalued. So the stock market may have put this one way too high. But hold on, let's just see about profitability. Okay, so actually this is quite telling right here. So the average is, they have a lot of stock-based compensation too. So the average is 6.5% free cash flow margin, but that is taking into some serious negative years right here, which is following COVID, which is kind of surprising to me because I would have thought during COVID, they'd be more profitable because people are home, maybe bored, but they've shown but maybe that was just when they've started scaling. And now they've started being profitable. And so their profitability is up to 25.7 in 2024. So let's bump it up. I know this is not the most conservative, but I just kind of want to see here. If I bump it up to 25% free cash flow margin. So I'm going to be using the best recent free cash flow margin. It still is a bit overvalued. So this is an instance where this company was just, the stock market thought this company was going to soar. Absolutely soar. And now it's dropping back down to fair value. Maybe that's, and this is the surface level look at this. So another thing we can look at, let's go to the, one thing I haven't looked at in a while is the Buffett supplement. And I should also look at this for gambling.com. So according to Warren Buffett, these are the red flags that he looks for in the income statement, balance sheet, and cash flow statement. So gross margins are high. Selling, general, and administrative costs are neutral. R&D is very high. Interest is very low. 0 interest expense. That's really good. Love that. Profit margin is now neutral. So yeah, their profits were very low. They were losing money, and now they've recently rose up to profitability. Long-term debt is 0. That is good. It makes it a much more conservative investment. The earnings per share has been going up. Profit's been going up. Inventory doesn't really make sense for this company. Retained earnings are starting to go up. Cash is going up while debt is staying pretty flat. Goodwill is going up. CapEx is low. Depreciation is low. High profit or high liquidity. Shares outstanding are going up. So they are diluting themselves in terms of shares outstanding, but over the last couple of years they've been flat. Okage gonna drop off. Good night. Thanks for tuning in. Appreciate it, buddy. Let's keep an eye on before you leave, if you're still there, gambling.com has their earnings report coming out soon. So I am taking a risk by investing $100 into this company before the earnings report comes out, but we saw that I have 38 holdings currently. This is going to be my 39th holding. So this is a very diversified portfolio. So I'm putting a small percentage into gambling.com. I would not recommend a large percentage of your portfolio going into this company because they're about to have an earnings report come out, which means there's going to be a lot of new information. So if you plan to put a significant amount of money into this company, don't until the earnings report comes out, because that would be more akin to gambling. So I'm going to keep this initial investment for myself very small, a small percentage of my portfolio. If the earnings report comes out and things are still looking good, my conclusion is still intact, then at that point, I might double down or triple down in this company. So just keep that in mind. There is more information about to come out on this company. So it still represents a significant risk. Okay. Good night, Hokage. Appreciate you tuning in. Okay. Back to Duolingo. Okay. Financials. Let's look at the financials a bit really quick. So their revenue has been growing insanely. That all looks really strong. Their operating income, they finally have positive operating income. They were hemorrhaging money before. Let's see. Shares outstanding. So they are starting to slow down with this, but they have diluted shareholders significantly. So if you owned a share in, what year is this? 2021, that share was worth, 1 over 23 million. Now it's only worth 1 over 48 million. So it represents half as much ownership in the company. Now the share price has gone up a lot, so your shares may have appreciated, but the ownership is decreasing in this company. And why is it decreasing? Let's go to the cash flow statement. Look at this. Let's look at 2024. $88.5 million they made in earnings. However, management decided to take $110 million for themselves in stock-based compensation. See, I just hate to see that. It's too much. It's too much. And then here they are. So this is what it is right here. So now they have to spend $50 million to buy back shares so that they're not diluting the shareholders as much. But now we're losing our earnings. We are the shareholders. We're the owners. Well, I'm not a shareholder of this company, but if you were a shareholder of this company, you would be the owner, not just the management. The owners are the shareholders, and the management is taking $50 million for themselves here. So I don't like to see that. Okay. Yeah, this is 50 million that's going to not all shareholders, just the, directors slash CEO slash whatever high level employees, whenever high level employees are getting this, it's not going to shareholders. Okay. Point made. But yeah, their free cash flow margin on here, so here they're showing free cash flow margin of 42%, but that's not true because they are benefiting here from 130 million. See, this is getting, so they're starting with 357 and then they're adding this 131 million to it, right? So this is pushing up their operating cash flow. And so it's pushing up their free cash flow margin here. So this free cash flow margin is not accurate in my opinion. That's not the free cash flow margin that I look at whenever I'm doing my analysis. So yeah, at this time, just on a surface level look, I'm still thinking that $209 is not, there's just not enough, what's the word I'm looking for? Margin of safety here. Now, if they are, let's just say they continue to increase their profitability over time. Let's say they increase it even more. They increase their profitability by 2% every year. So this graph shows my free cash flow margin. So this is the true free cash flow margin. And then I'm showing that they're going to increase that free cash flow margin over the next 5 years. And if we assume that, and we assume, and also we're assuming that this is going to be their baseline going forward. So this could be like a high point for them, and they may drop off, in the near future. This could be like an outlier year. But if I assume that this is their baseline free cash flow margin, and then the free cash flow margin continues to go up from that point over the next 5 years and stays up there, then they're about fairly valued. So yeah, even with their recent drop, at first glance for me, Duolingo still appears to be a bit too expensive for my taste. Not really. Rob asks thoughts on them expanding into chess and etc. I could see it. I like it, I guess. I guess I don't have too many thoughts because I'm just hearing about this for the first time. I did not realize that they were expanding into chess. I guess I don't have an issue with it. Is there synergy? That's the main question. Whenever I think about an acquisition, I like to ask, is there synergy? Because if the company is a good investment and then they're acquiring something else, does that thing help the company that I'm investing in? I'm not investing in a chess company. When I'm looking at Duolingo, I'm investing in, the language app. And so if they are expanding into chess, can I count on similar returns? I don't know. It's like another thing to look at. So I guess I would have to dive into how profitable, say, chess.com is. It is kind of cool that, it's like learning a language, and then learning chess is almost like learning a language. So I don't know. I'm not mad at it. But in terms of my assessment so far on Duolingo, I am just looking at the analysts. So what I'm assuming is that the analysts are doing their job. It is their full-time job to look into the future and determine what is a likely future for this company. So the analysts are taking into account, assuming these are up-to-date analyst projections, the analysts are taking into account expanding into chess. And so then I am using the analyst projections for future revenue. That is my philosophy. I like to depend on Critical Process. Says, thank you, man. No problem. If you got any more stocks you want me to look at, throw them out there. The Duolingo, this type of company is the company I like to look at, though. Companies that have a significant drop, I'm looking for potential shareholder overreaction, market overreaction. So this was a good one to bring up. Unfortunately, they still have not dropped low enough for my liking. But yeah, what was I saying? Oh yeah, so the analysts, it's their job. They spend way more time analyzing a single company than I have to analyze that company in terms of their future revenue projections. I'm trying to invest in a diversified fund, so I can't possibly spend more time on every single company that I invest in than each analyst. It's their job to do that. So that's my philosophy. I really lean on analyst projections, and then sometimes I will read between the lines for industries that, you know, in my experience, they seem to be on the rise. My observation, there's other ways that I can research the sectors and the industries that I think are going to be rising more than others. And then I can look at companies within those sectors. But at the end of the day, I still use the analyst projections for my revenue projections. So anyway, okay. So we were also going to look at Simply Good Foods. This is the worst company in my portfolio. Is it still worth investing in according to the analysts? Let's see. Let's go ahead and copy the revenue projections. SMPL. Let's zero these out. Oops. Right off the bat, it's looking incredibly promising. Oh, but I have the wrong revenue projections in there, of course. That that makes a huge difference. Okay, and it still looks very promising. Okay, so based on analyst projections, average, they're saying about 5% going forward. If the average analyst is correct, and Simply Good Foods has 5% revenue growth going into the future, I'm going to assume a perpetual growth rate of 2%. To be conservative, we'll say in years 6 through 10, their revenue growth slows down a bit and they only hit 3% going forward. Then this is the spread of share prices. Let's also double check profitability here. So I have a past free cash flow margin of 12. What is it? What is it really? So because they have a small stock-based compensation, their average is actually more like 11. I'm also counting a little bit of CapEx in their favor. So really what I should be doing is looking at what percentage of their capital expenditures is maintenance versus growth, and then make that distinction. Right now, as a default, I'm assuming 10% growth, 90% maintenance, which I see as very conservative. So let's reduce their free cash flow margin to 11. Means we do -1. Okay, with reduced free cash flow margin, according to the average analyst, there is a 42% upside. If we go a little bit more conservative and we just assume 2% revenue growth starting now and forever, and they never increase their profitability, then there is a 20% upside on top of my 8% return. So in my mind, Simply Good Foods still looks undervalued. In fact, I think I would be justified in putting another $100 into Simply Good Foods. I may not yet. And this is an example of a company that is in an industry that I think is likely to do well going into the future. Now, I'm still going to use analyst projections, but Simply Good Foods combines two things. Health, which it seems to me that health consciousness is increasing in the US. So healthy foods and convenience. So Simply Good Foods, it's like it's Atkins, it's Quest protein bars. It's they're really divesting in Atkins. They're moving away from Atkins and they're putting more into Quest and other protein bars. You know, just convenient, healthy foods. You know, whether or not you think it's actually healthy is kind of beside the point. It's marketed as health products that are very convenient. And so I think that combination is going to do really well in the future, because to me, it seems like convenience is just, it is of increasing priority in America. That's what I see. Health is also an increasing priority. These two things kind of come together. I feel like this is in a rising tide situation, a solid industry to be in. The analysts think it's going to be going up. If they only go up by 2%, then there should be an upside. So I still like Simply Good Foods, even though it has performed. It is my worst performing stock so far. So anyway, that's all I got for today. If anybody has a company that they want me to look at in the next video or the next live stream, I'm streaming every single Wednesday at 7:30 p.m. I hope you guys tune in next time. Let me know if you have any stocks you want me to look at. I'm happy to do just a very quick, surface level analysis of a discounted future free cash flow. And we'll look at the intrinsic value, what we think. And I'll see you guys next time. Thanks for tuning in. I need to get better